What's up, guys? Welcome back to my channel. In today's video, we're going to be talking about the news that just recently came out about the new US government regulations on Chinese stocks and how this relates to Alibaba. So sit back, grab a cup of coffee or your favorite beverage of choice, and let's jump right into it. What's up, everyone? Welcome back to my channel. As anyone who follows stock market news is aware, we just saw huge regulatory news come out of the House of Representatives earlier this week.
The House of Representatives on Wednesday unanimously passed a bill that threatens to delist Chinese companies such as Alibaba and JD.com from U.S. exchanges unless U.S. regulators are able to inspect their financial audits within 3 years. Of the China-related measures introduced in recent months, the bill could have the broadest impact on investors' portfolios. With the House vote, the Holding Foreign Companies Accountable Act goes to President Donald Trump, who is expected to sign the measure. The Senate already passed the bill over the summer. The SEC has also been working on a related proposal that the Wall Street Journal reported would put the responsibility on exchanges to require audit, inspection, compliance. President Donald Trump, who has no desire to make nice with China in his final weeks, is expected to sign the Holding Foreign Companies Accountable Act. Under the Holding Foreign Companies Accountable Act, China stocks would face delisting within 3 years unless their auditors come under supervision of the Public Company Accounting Oversight Board.
So what does this mean for us as investors and for Alibaba as a company?
As we all recall, the Trump presidency has been largely focused on China, dating back to 2018 when the trade war initially started, resulting in tariffs going back and forth between the two countries. What resulted was a dramatic pullback in Alibaba's share price and the company trading sideways for approximately the past 2 years, only to begin its uptrend at the beginning of 2020 and ultimately having another pullback at the start of the pandemic. As you can see, the share price had a huge spike recently, but on the news of this potential delisting, it again has started to have a pullback.
Alibaba is the largest e-commerce corporation in China, and they are not only integral to the Chinese economy, but have also had enormous growth throughout all of Asia. Alibaba is much more than an e-commerce corporation, however, and for example, they own approximately a 30% stake in Ant Financial, a large fintech corporation in China, similar to Venmo and PayPal here in the United States, that was just recently set to go public as the largest IPO in stock market history, but has been delayed due to conflict between Jack Ma and the Chinese government. In the wake of these new regulatory concerns, many American investors have been quick to sell their shares of Alibaba. If the company were to choose to not comply to the new US regulatory demands, then Alibaba would be delisted from the New York Stock Exchange over the next 3 years. For investors, you would still own the shares, but the value would likely plummet because the liquidity would not be the same as it is now on the New York Stock Exchange. The idea behind these new regulatory demands is to ensure that Chinese companies are not cooking the books, like we saw earlier this year with Luckin Coffee, who were fabricating their numbers and were subsequently delisted from the New York Stock Exchange. As it currently stands, Alibaba is trading with approximately a $720 billion valuation, and from my personal evaluations, I believe that it is well undervalued at this point. Alibaba is essentially the Amazon of China, rivaling them not only on their e-commerce business and their cloud services, but also with their investments such as the Ant Group, like I previously mentioned. Personally, I believe that Alibaba should be valued well over a $1 trillion market cap at the present time, and within 3 to 5 years, its market cap could rival that of Amazon as it is right now. I personally have been an Alibaba investor since 2018 when the trade war initially began, holding shares with a cost basis of approximately $180 per share. While I am incredibly bullish on Alibaba in the long term, I do recognize the risk associated with this investment. When Alibaba just recently reached its all-time highs just prior to the suspected Ant Group IPO, I did sell half of my shares to lock in some short-term profits. While I am going to hold half of my position long-term due to the incredible long-term growth opportunity that I feel Alibaba has in front of it, with the other half of my position, I'm going to do short-term swing trading, trying to pick up some short-term capital gains and then lock those profits into what I feel are safer long-term investments in dividend-paying companies that have been beaten down because of the recent pandemic. Just like any investment, it's all about the potential risks and the potential benefits. While I do feel that Alibaba has enormous long-term growth opportunity ahead of it, I want to lock in some of my short-term capital gains and transfer those funds into other assets that I feel are also beaten down, have potential growth ahead of them, and will be able to produce cash flow with the dividends that they pay. What are your thoughts on Alibaba? Is it a company that you're invested in, and where do you think it could go in both the short and the long term? Be sure to comment below and let me know what you think. As a reminder, I'm not a certified financial planner. I'm a resident physician with an interest in personal finances and investing. Please make sure you're doing your own research before you make any investing decisions. Alright guys, if you're still here at this point in the video and you haven't already, please be sure to smash that like button and click on the subscribe button for the YouTube algorithm and to help my channel to grow. Thanks everyone. Have a great day.